right now, we're going to be talking to Anindya Mitra, who's Vice President and Senior Analyst, Sovereign Risk Unit at Moody's Investor Services. Anindya, good morning. Thanks very much for being with us. It's the fag end of 2009, and it's a good time to take stock about how you view India. One gets, of course, the broad signal from the December 16th local currency rating upgrade that the Indian economy structure is robust, things are looking good. Is that an overstatement?
I don't see why that should be seen as an overstatement. I mean, there are undoubtedly some inflationary risks down the line that need to be dealt with by the policymakers. But I think the growth story certainly looks intact. It certainly surprised on the upside with the most recent quarterly numbers looking so strong. So, and given the fact that we broadly expect the fiscal ratios to remain broadly in line with budget estimates, and the debt ratios should also, as high as they are, we expect them to be on a stable to declining trend in the medium term. The extent to which these credit metrics will improve depends also on what the next Fiscal Responsibility and Budget Management Act recommends. But nonetheless, I think, very broadly speaking, the ground is being set for an upturn, not only from an economic standpoint, from a sustained upturn, not only from an economic standpoint, but also stable to improving credit ratios in the medium term. So that's what influenced our decision to take a positive outlook on the local currency ratings, which, by the way, have been lower than our competitors because we have been skeptical about the government's ability to manage its debt ratios down through the medium term.
Okay. You know, you said the stage is set for, strong growth. But in a sense, the stage is also set, perhaps, for the government to roll back some of the stimulus actions that it had unleashed early this year, late last year. Is all your focus now going to be on watching the government's move on the rollback plan?
Yeah, I think one can expect a cyclical improvement in the deficit simply because some of the items that were a part of the stimulus package, such as the farm debt waivers or the pay commission arrears settlement and so on, are non-recurring items, and they will roll off the budget. So that alone could account for between 1% and 2% of GDP improvement in the fiscal deficit in the next fiscal year. Then you come to the revenue side of the equation, and we expect that, once again, on a cyclical basis, the share of revenues in GDP could easily increase by about at least 1% of GDP, looking at a very conservative estimate, without even requiring any tweaks in tax ratios and so on. So when the GST does come into play in late 2010 or early 2011, that will set the stage for a structural improvement in the medium-term part of the deficit. And so we do expect a cyclical improvement in the deficit with or without any structural measures taken by the government. And that's what we think is significant for an economy that is still growing at approximately 7 to 8%, and its trend growth ratios could pick up to between 8 and 9% in the not too distant future. So, and hence I think the downside fiscal risks are limited by the response of tax revenues that we are seeing, especially direct tax revenues, have continued growing at a very healthy clip. Indirect tax revenues need some tweaking. I think the central VAT, excise taxes, and customs duties are down, but those are more cyclical in nature. But very broadly speaking, the deficit is not an item of that much concern, provided the government itself remains committed towards reining in the fiscal deficit in line with its medium-term fiscal responsibility objectives.
All right. Just to go back to the global picture, and everybody's talking about a sharp counter trend rally in the US dollar. Could that probably reveal some nasty surprises, some skeletons which are right now hidden away. Of course, everybody is also worried about sovereign risks with Greece being in focus, that sort of thing. I'm just trying to understand 2010. What to expect? I know a lot of these things come out of nowhere. Dubai, for example, that sort of thing. But would you be watchful for any such surprises?
Yeah, I mean, we have gone on record saying that 2010 is going to be an exceptionally challenging year for sovereign ratings, especially in Europe as well as emerging Europe. And the way we see it is that late 2008 was a year of commodity price shocks and the financial shock that really hit the whole world. 2009 was a year of a growth shock. 2010 will be really a year of a continuing fiscal shock that is derived from the growth shock of 2009. So whether countries like it or not, everybody will have to formulate exit strategies. Nobody can continue running 8, 9, 10, 12% budget deficits indefinitely without triggering a loss of monetary confidence. So to that extent, the balancing act between crafting a successful exit strategy, but also not triggering a relapse of an economic recession in several countries, will be the trickiest aspect of policy management in 2010. To that extent, or keeping that in the background, or in view of this tricky balancing act, I think the extent to which the markets get spooked by specific country developments, be it in Dubai, be it in Greece or some other place, will continue to impact risk perceptions on a global basis, and that in turn will continue to drive risk aversion or flight to quality, be it into USD and so on. So the aftershocks will persist for some time, but we think this is something that we are well aware of. And we are certainly thinking through this analytically to approach which countries are ordinal winners in a sense, and which countries have long-term solvency problems. And most of them are predominantly in Western Europe and some in emerging Europe as well.
Okay, so watchful of sovereign issues in 2010. And good speaking with you and getting your thoughts across as always. Here's wishing you a prosperous 2010. From everybody here at NDTV Profit.